Amsterdam, 1637. A single tulip bulb sells for the price of a canal house. Not a bouquet, not a garden. One bulb. One flower that hasn't even bloomed yet. For the price of an actual house on an actual canal in one of the most expensive cities in Europe. And the thing is, the person who bought it wasn't an idiot. They were a merchant, probably quite successful, operating in a market where tulip prices had been doubling and tripling for years. Everyone around them was getting rich. The logic wasn't, this bulb is worth a house. The logic was, someone will pay me even more for it tomorrow. They were right, until they weren't. When the market collapsed, and it collapsed fast in a matter of weeks, tulip bulbs went back to being worth roughly what tulips are worth, which is to say, not very much. Fortunes evaporated. People who had mortgaged their homes to buy bulbs lost everything. The Dutch called it windhandel, wind trade, buying and selling something made entirely of air. That was almost 400 years ago. We have learned absolutely nothing. So what actually is an asset bubble? An asset, a stock, a house, a tulip, a piece of digital art, has what economists call a fundamental value. Its fundamental value is basically what it's actually worth based on what it does or produces. A stock's fundamental value is roughly tied to the company's actual earnings. A house's fundamental value is tied to what it could rent for, what it costs to build, what people in that area can actually afford to pay. A bubble is when the price of an asset gets dramatically detached from that fundamental value. Not a little high, not overpriced, dramatically, unsustainably, obviously in retrospect detached. The key word there is obviously in retrospect, because in the moment, it almost never feels like a bubble. It feels like a new era, a paradigm shift. The old rules don't apply. This time is different. This time is different are the 4 most expensive words in the English language. That's a quote from the economist John Templeton, and he spent decades watching people say it right before they lost everything. Here's the anatomy of a bubble. Because they all follow roughly the same shape, from tulips in 1637 to dot-com stocks in 1999 to housing in 2007 to crypto in 2021. It starts with something real. Tulips really were exotic and beautiful and scarce, and wealthy Europeans genuinely wanted them. The internet really was going to change everything, and it did. Housing in America really was undersupplied in many cities. Blockchain technology really was a genuine innovation. The bubble doesn't start with nothing. It starts with a real thing that gets extrapolated way, way past what the reality supports. Phase 1. Smart money moves in. Informed early investors see genuine potential and buy in at reasonable prices. Returns are good. Word gets around. Phase 2. Everyone else shows up. The story gets told at dinner parties. Your coworker mentions it. Your uncle calls. Prices rise faster. Returns are great. More people show up. Phase 3. Prices are now untethered from fundamentals. But no one cares, because prices keep going up, and going up is what matters. You can always sell it to someone else for more, is the operating logic. Economists have a name for this, the greater fool theory. You might be paying a crazy price, but you're not the fool. You just need to find a slightly greater fool to sell to. Phase 4. Someone blinks. Could be anything. A big investor cashes out, a piece of bad news, an interest rate change. Sometimes there's no identifiable trigger at all. The market just stops believing. Prices stall, then dip. The people who were planning to sell to a greater fool suddenly realize they might be the greatest fool. They sell. That makes prices drop more. More people panic sell. Prices collapse. Phase 5. The aftermath. The asset often ends up below its fundamental value for a while, because now everyone is terrified of it. And then, slowly, it recovers to somewhere reasonable. The cycle resets. This is not a modern phenomenon. This is not a capitalism problem or a regulation problem or a technology problem. It is a human psychology problem. And it has been happening in every market, in every era, for as long as markets have existed. Let me give you the one that really broke things. The 2000s US housing bubble. Banks were giving out mortgages to people who couldn't afford them, sometimes without verifying income, sometimes without any down payment. These mortgages were bundled together, sliced up, given fancy ratings by agencies that had a financial incentive to give them fancy ratings, and sold to investors around the world as safe products. Housing prices had been rising for years. The story was, American house prices never fall nationally. They go up. Always have. Buy now before you're priced out forever. Almost everyone in the system had some incentive to keep believing the story. The mortgage broker got paid to write loans. The bank got paid to bundle them. The ratings agency got paid to rate them. The investor was getting good returns. The homeowner was building equity. As long as prices kept rising, everyone was fine. When prices stopped rising, everything that had been hidden inside that system became visible at once. Banks were insolvent. The mortgages underlying all those fancy products were defaulting. Trillions of dollars in paper wealth disappeared. The global financial system came within a few days of complete collapse. 8 million Americans lost their jobs. Millions lost their homes. Not because of tulips, because of houses. Regular houses in regular American cities that got priced like they were going to the moon. So why do smart people keep getting caught in bubbles? Like, these aren't all naive people. The 2008 crisis wiped out hedge fund managers with PhDs. What's going on? A few things. 1. Social proof. When everyone around you is making money on something, not participating feels like the irrational choice. You're the odd one out. You're leaving money on the table. There's enormous social and psychological pressure to get in. Humans are herd animals. The herd is running toward the tulips. 2. The incentive problem. Even people who know a bubble is a bubble often can't afford to act on that knowledge. There's a famous quote attributed to Keynes. The market can stay irrational longer than you can stay solvent. If you're a fund manager and you sit out a bubble, your clients fire you for underperforming. So you participate anyway, trying to time your exit. Most people can't time their exit. 3. Narrative over numbers. Humans don't make decisions based on discounted cash flows. We make decisions based on stories. And bubble assets always come with an incredible story. The new world, the railroad age, the internet revolution, the democratization of finance. The story is usually partially true, which makes it much harder to dismiss. But the technology is real, but people really do need houses. Yes, true. But that doesn't mean any price is justified. How do you protect yourself? You can't always. Bubbles are part of markets the way storms are part of weather. But a few things help. Ask, what's the fundamental value here, and how far is the price from it? If nobody can answer that question, if the conversation immediately jumps to, but prices are going up, that's a signal. Ask, who needs me to believe this? Every bubble has salespeople. Not necessarily in bad faith, they might genuinely believe it. But if the person telling you to buy has a financial interest in you buying, apply extra skepticism. And the hardest one, when everyone is saying this time is different, that's almost always the moment to be most skeptical, not least. The phrase doesn't mean the world has changed. It usually means the bubble is in its later phases and needs a story to sustain itself. Back to Amsterdam, 1637. Here's the part they don't tell you in the story. Most of the tulip traders knew it was crazy. There are letters from the period where merchants write to each other saying essentially, I can't believe what's happening. Prices make no sense. They weren't oblivious. They were participating anyway, each one convinced they would get out before it collapsed. Some did. Most didn't. The tulip was never worth a house. Everyone kind of knew that. But the person next to them was getting rich, and the price kept going up, and surely they'd sell before the end. This is the cruelest part of a bubble. It doesn't require ignorance. It requires only the very human belief that you're a little smarter, a little faster, a little luckier than everyone else. Sometimes you are, but the house always wins.